Silicon Data, which provides pricing and performance benchmarks for AI compute, has raised a $30.5 million Series A to help grow its tools and capabilities. Joining us is Silicon Data CEO Carmen Li. She's also the former head of strategic alliances for enterprise data at Bloomberg. Congrats on the round. Really interesting group of investors that have backed you. You've grown very fast, and I think that the best place to start is how are you going to use the funds? What is it you're trying to get going on?
Thank you, Ed. Thanks for having me on the show. So it's a quite exciting week for Silicon Data. As the NVIDIA story rolled out, as CME announcement came out yesterday, our goal really become the independent referee for the whole compute stack. So as independent referee, we need to keep developing indices. As there are more chips, there's more token, there's more LLM models coming online. We need to design next generation of benchmarking services. This is all going to be used to design products and software applications.
Carmen, very quickly, the valuation wasn't disclosed. Can I just ask you what the approximate valuation of Silicon Data was in this round?
It is a very healthy range.
Are we at unicorn status yet?
Not quite yet, but I will definitely ping you.
We'll get that out of the way. Really interesting. Gavin Baker with Valor through the Valor Atreides AI Fund led this round. What should we take from that? Beyond just the check and the capital, what are you able to get from their sort of expertise and background here?
So Gavin and the team, they are the pioneer in the whole compute industry. They're the one backed a lot of new clouds from a very early stage. And we're also backed by CME, F Prime, which is part of the Fidelity ecosystem, VanEck, obviously DRW, Jump Trading. So we, as independent referee, we want to make sure our product is very well aligned and then is useful for the market participants who are the natural long and natural shorts. So that's why we're excited about the whole suite of investors that's going to be heavily our clients at the same time.
Right. The big thing that's to come is CME planning GPU futures that are settled against your benchmark. What's the progress there, and what is it that actually will be traded? Just explain to the Bloomberg Tech audience that might not be familiar with this story, the basics.
So it's quite exciting. So the news came out, CME, the planned date is October 5th. The first suite of indices is going to be cash settled against our H100 and E200 Neo Cloud on-demand indices. So what's interesting, there's two actually volatility the market want to hedge. Number one is if you are natural longs of GPUs, meaning you own tons of servers, obviously your revenue is tied with the rental rates. And for you to hedge out the future volatility, you really want to short futures. You do not care about physical delivery because you already have your servers. All you're looking to do is hedge out the price volatility in the future years. If you are a consumer of compute, consumer of GPU, obviously you're paying the rental prices. Ideally, you will lock prices in for a duration of time so you can long the futures and lock in certain prices. So that's really the use cases for natural hedges.
That takes us to the bigger picture, and you referenced it. The NVIDIA $500 billion with all of those investment firms raised a lot of questions. For example, well, are these not assets that depreciate? How do you, in your benchmark, reflect compute as collateral? Just go through some of those ideas.
Yeah, so it's actually the same story. The NVIDIA $500 billion story is about a financing layer. CME and Silicon Data story is about risk management layer, right? So you need both. You can't have a market about $500 billion size without way for the investor, the people with exposures, having a place for them to hedge and then have price discovery. So
let me ask you this, though, Carmen. Let me ask you this as a quick follow-up, and I'm sorry to interrupt. What does your data tell you about how quickly a GPU generation can depreciate? Like what I see in the news right now is A100's very high utilization very high pricing, but they're generations old.
So great observation. So what's interesting is A100 and H100 prices have been pretty stable for the past 20 days. So the price went up about 20% for both chips since January this year. The last 20 days has been pretty stable. The way I will read is, so there's a few points you raised before. Just because something depreciates, server is a machine, right? The machine depreciates, just like aircraft carriers, just like ships, right? Everything depreciates in terms of its lifespan. Doesn't translate to just because something depreciates, meaning they have no economic value, right? So you look at residual value calculation for any asset class is looking at future cash flow of that particular assets. And for the A100, to your point, right, it's an older chip, but people can still use that for different workflows and for smaller model use cases. Then they can keep charging at whatever price they, the supply demand curve meet. Exactly. Yes. And even L40s, right? Forget about A100. And L40s has machine learning use cases, which is completely
right. That takes us back many generations. To end, I've got a question from the audience quickly, very interesting. Jukan on X. What are 3 signals in Silicon Data's data over the next 2 to 3 years that would tell you AI infrastructure oversupply has begun?
So, great question. So there are 3 data points I can actually really good to take a look. Number 1 is spot prices, right? Spot prices is where supply and demand meet. If spot prices keeps coming down for a period of time, you can argue either there's less demand or there's just outpacing supply, which is not really the case right now. Number 2 is forward curve, right? If the forward curve is contango, which is kind of we have now, that translates to people are paying even higher price to lock in a longer term contracts versus short term rental. So that doesn't say it's oversupply, right? However, if the forward curve became very steep downward sloping curve, then the implied rate for the future, meaning it will comes down quite a bit. The third indicator is residual value, right? If the secondary market transactions of any servers, those prices came down, that represents people's expectation of those future revenue of those servers will be coming down. Right, so residual value from the secondary transactions is also a good point.